Welcome to the chapter on the history of finance. Understanding the evolution of financial systems is crucial for grasping modern financial principles. In this chapter, we will explore early forms of trade and barter, the invention of money, the birth of banking, the development of financial markets, and the rise of modern finance. Before the invention of money, people relied on barter systems to exchange goods and services. For example, a farmer might trade a bushel of wheat for a pair of shoes from a cobbler. While barter systems allowed for trade, they had significant limitations. The double coincidence of wants meant both parties must have what the other wants. Indivisibility made it hard to divide some goods, like a live animal, and there was a lack of standardization, with no common measure of value. The limitations of barter led to the creation of money, which serves as a medium of exchange, a unit of account, and a store of value. The first forms of money were commodities like gold, silver, and other precious metals. Commodity money is money whose value comes from the material it is made of. For example, gold coins have intrinsic value because gold is a precious metal. Fiat money, on the other hand, has no intrinsic value but is valuable because a government maintains it and people have faith in its value. Modern currencies like the US dollar are examples of fiat money. The need for safe storage of money and the facilitation of trade led to the development of banking systems. The first banks were established in ancient Mesopotamia around 2000 BCE, where temples and palaces provided secure storage for grain and other valuables. Banks play several critical roles in the economy. They accept deposits, safeguarding money for individuals and businesses. They provide loans, lending money for various purposes, and they facilitate payments through checks, wire transfers, and other methods. Financial markets have evolved to facilitate the buying and selling of financial instruments like stocks, bonds, and derivatives. These markets help allocate resources efficiently and provide liquidity. Stock markets allow companies to raise capital by issuing shares of stock. Investors buy these shares, becoming partial owners of the company. The first stock exchange was established in Amsterdam in 1602 by the Dutch East India Company. Bond markets enable governments and corporations to borrow money by issuing bonds. A bond is a fixed income instrument that represents a loan made by an investor to a borrower. The yield of a bond can be calculated using the formula yield equals the annual coupon payment divided by the current market price. For example, if a bond has an annual coupon payment of $50 and its current market price is $1,000, the yield is 50 divided by 1,000, which equals 0.05 or 5%. The 20th century saw significant advancements in financial theory and practice. Key developments include the creation of the Federal Reserve System in the United States, the establishment of international financial institutions like the International Monetary Fund and the World Bank, and the development of modern portfolio theory. Modern portfolio theory, developed by Harry Markowitz in the 1950s, provides a framework for constructing portfolios to maximize expected return for a given level of risk. The key concept is diversification, which involves spreading investments across various assets to reduce risk. The expected return of a portfolio can be calculated as E of R sub P equals the sum of the weight of each asset times its expected return. For a portfolio with two assets, if asset A has an expected return of 8% and a weight of 60%, and asset B has an expected return of 12% and a weight of 40%, the expected return of the portfolio is 0.60 times 0.08 plus 0.40 times 0.12, which equals 0.096 or 9.6%. The history of finance is a testament to human ingenuity and the continuous quest for better ways to manage resources, facilitate trade, and create wealth. From barter systems to modern financial markets, each development has built upon the last, leading to the complex and dynamic financial systems we have today. Understanding this history provides a solid foundation for studying the principles of finance and applying them in real-world situations.